Happy Friday, August 18th, 2017 to you all. Happy standard options expiration, although I know many of you are actually trading weekly options, so of course you have a variety of positions that you probably close out every week and probably already set your positions for next week's expiration or maybe 2 weeks out as well. Well, welcome to today's presentation, our open forum Q&A session. I hope you all brought your questions. Before we begin the presentation, we just want to, of course, discuss what is Power Options. Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options to identify only those positions that match your personal risk-reward tolerance in over 23 of the most commonly used option strategies. Once you have identified the positions, of course, you can further research and analyze the stock or the option, evaluate what-if scenarios, and of course track and manage your positions with our powerful set of portfolio tools as well. In addition to that, of course, we do offer countless help videos, archived webinars, flash tutorials, and white papers, blogs, and articles to get you more familiar with the tools on the site, but more importantly, the various option strategies, management techniques, and more. Ernie Zarena created the Power Options tools back in 1997. Of course, everyone here on staff, myself included, uses these tools to trade their personal accounts, so we have many more years of combined trading experience. Now, our process and procedures for our Friday afternoon's presentation, I don't have any planned material. And this presentation is designed for you to have an open forum to have your options investing questions answered. When you logged on to the webinar, the GoToWebinar platform would have appeared on your screen. Inside that platform is a question pod, so just use the question pod to send a question to us at any time during the webinar. Now, please feel free to ask any questions as you want, and as many questions as you want. We're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time. However, if we have a high volume of questions, I'll be more than happy to stay on until maybe 5:45 or 6 o'clock to make sure that all questions are handled. Questions can be about anything related to options investing. If you have a question about general options strategy, why would anyone ever sell an in-the-money covered call? What should I look for when buying a call or buying a put? How do I structure a spread position? And so forth. That's all fair game. Of course, we are at expiration for August 2017, so if any of you have questions about trade management, how could I have rolled or adjusted a particular position prior to expiration or before the markets closed today or last week when the trade started to go against you? Of course, if you have questions about just option specifics, what is delta, what is gamma, what should I expect for implied volatility and so forth, or just general basics as well, feel free to send those to us. Many of you online are probably Power Options trial members or subscribers, so of course you have questions about the tools and Power Options, send those to me as well. Some of you, of course, might be following the radioactive trading technique, so I encourage you to send questions about those also. Our basic ground rules, don't be shy. Please feel free to ask any questions that you want at any time during the webinar. We do ask that you be patient. There might be 1 or 2 questions ahead of yours, and as I mentioned, we will get through them all. I also want to encourage you to feel free to help us help others. If a question comes in and I give a response based on my market experience or what I have done in my personal account, but you have a different way of evaluating a position or managing a position, I encourage you to use the question pod to send that to us as well, and we'll share that with the rest of the audience. Most important, let's have fun. We've got another trading week ahead of us as we wrap up August 2017 or get close to it, heading into September, with just one more full expiration in August and then half a week of trading in August before we get into September 2017. So anyway, let's have some fun. Let's get some good education under our belts and see what we have going forward. All right, now I'm going to navigate over to the Power Options suite of tools. We're going to use this to illustrate, of course, the questions that come in, and let me just make sure I get this set up right. Of course, there we go. All right, so everyone should be seeing the Power Options tools now. Fantastic. Okay, so we do have a couple of questions that have already come in. All right, Sam says, hello everyone in the room, good afternoon. Okay, and then Sam's comment or question, he says, short-term calls or puts to adjust is a little difficult and can be out of hands for losses. And that's very true. And what Sam is referring to there is that if you're buying weekly calls and weekly puts, not something I typically do. Okay, I like to give myself more time. So when I'm doing a long call or a long put, buying a put option speculating that the market's going to fall or the security is going to fall, or buying a call speculating on the opposite, that it's going to rise, the weekly options are inexpensive. You know, those that, if I open a position on Monday that expires 4 days later, they're pretty inexpensive. And you can imagine, or I should say fantasize, of a 400% return, a 500% return on your investment because of the cheap price of the option. However, there's a lot of movement, and there's a lot of things that can happen, and unfortunately a lot of subtle movements where your option might look profitable by a little bit. Let's say it's 10 or 15% profit, and then the next day it's at a 20% loss. And then the next day it's at maybe a 12 or 15 or 20% gain, and the next day it sort of drops 5 cents and you're at, you know, a 1% gain or a 1% loss. And then it pulls back, and then in one day, in the last day, you might be at a 40 or 50% loss. It's really hard to manage those because the only thing you can really do, if I bought a call for a weekly option, for example, and the market's not doing what I want, I can't really sell multiple times against it. There's only one expiration cycle that I can sell to try to minimize it. But of course, with the option fluctuating frequently and the underlying security fluctuating over that 4-day period, I might actually get myself into a loss on the position by trying to manage it by selling something shorter term. I had a good conversation with a gentleman the other day who was getting into calendar spreads. He's done calendar spreads in the past. He hadn't been trading for 2 to 3 years. But he's getting back into calendar spreads, and what he's doing is essentially buying call options that are maybe 45 to 60 days out in time, and then trying to sell 8 calls against it. So it's a diagonal spread, a calendar spread, but he's doing it in a shorter time frame. Now let me go to the chain here, the option chain for TJX, and I'm just going to look at the call chain, okay, for right now. And what I'm going to do is, using our historical tools, on a trial account, if you're in a power options trial, you can go back about 3 months, but I'm just going to go back to Monday, the 14th here for TJX. Let's go ahead and get the chain. Well, at the time the stock was trading at 69.62. Now, the call here is inflated. We'll look at another stock in a moment. But the call here is inflated. It's priced at about 180 in the at-the-money call. The reason why, of course, is that earnings were coming up for TJX, I believe, on Wednesday. Okay, but what this chain is showing us is from Monday, August 14th, when the stock was at 69.62 at the close, the at-the-money 170 or 70 call was priced, we'll say 180 at midpoint. Now we go to the next day. Okay, there's a little bit of movement of 54 cents. But see, here's the catastrophe. The option, 3 days left to expiration now, is only worth 60 cents and the stock moved up. Why? Well, this was the earnings. It didn't really have a remarkable turn to it. But let's say that we saw the earnings not really positive, not really negative on TJX. It bounced a little bit in the morning and then pulled back. It was up 54 cents on Tuesday. So we say with 3 days left to expiration, maybe I buy a 70 call for now about 70 cents, right? If we bought it the day before earnings, and Sam, I know that's not usually your approach. You wait till after the earnings and see what happens to play a position. But let's say we bought a weekly call on Tuesday for TJX, still showing some strength here, a little bit of pop after earnings, and we paid about, well, let's say 75 cents, okay, for our 70 call. And then what happened the next day? Well, it went up $1.43. So this is looking pretty good. Made about 100% return. We could sell it for about $1.55, $1.60. It's called 110, 115% return. But we still have 2 days remaining. So we're on Wednesday. The stock moved up. The 70 strike call is looking pretty good at 110% return. But if we didn't close it on the next day, now we're losing. Remember, we paid 75 cents for it, so now it's probably worth, we could sell to close it for 55 cents. So we lost about 20 cents. We're close to about a 28% loss on the position. So we went from 100% gain, 110, 115% gain one day, to now probably about a 28% loss on the next day, with one day remaining to expiration. Well, we don't want to take the loss. So we hope for there's a pop the next day, okay, and the stock moves up, and it stays right about the same. So we get out still with about a 28% loss. Now that whole time you say, well, you could have sold something against it. Well, not really. Let's go back again 2 more days to after earnings. It was the 15th, I believe. Okay, so after the pop, well, if I bought here at 75, I could have sold the 72.5 for maybe 8 cents. It's not that much. The only day we could have done anything to manage it would have been we had this large pop-up in price. But see, now we're still only getting 15 cents against it. We paid 75, could have sold the 72.5. This would have created a bull call debit spread for 15 cents. But then again, we go to today and we see where we're at. Probably could have closed it for 50 cents. Still would have been at a 15-cent loss, okay? The management with buying calls, buying puts, short term, as we'd usually consider, well, if I had bought a call 3 months out in the form of a diagonal spread and I wanted to sell weekly calls against it or even sell calls against it or have time to manage it, that's one thing we lose with the weekly options. And if you're greedy, I know it's tough to say, but remember on that second day in, on Wednesday, you could have had 120% gain, but if you didn't close it, then it wouldn't have been a profit. Okay, because the next day it would have given all that back, and price was about 60 cents when you would have gotten in on Tuesday at 75 cents after the earnings. Okay, so you were at a small loss on the position, but still, that's what makes it difficult, is knowing when to sell and knowing when to get out with these options, these weekly options. Now, customers I've talked to over time who do trade long calls and long puts with the weekly series, they have a tighter target. And what do I mean by that? Over the years, when weekly options weren't available, most investors I talked to who were buying call or put options maybe 2 months out, 3 months out in time to give the stock more time to move in their desired direction, but at the same time maybe planning on playing it as a calendar spread as well. Okay, what they were looking to do is maybe get out if they had a 30, 40, or 50% gain on the, or 100, I'm sorry, let me rephrase that. When they were going 3 months out, they were looking for that target of 100, maybe 200% gain, especially if there was a large movement for an unexpected event, not earnings, that's expected. We know when that's coming up. But investors I've talked to who trade long calls and long puts with weeklies now, their target is usually around 30% or 40%. They get out when they hit that target because they know very quickly it could turn around against them. What's very difficult, though, is setting a stop to the bottom. This is another conversation I had with a gentleman today. It was more related to spread positions. But if I had bought this original position at 75 cents on Monday, I'll get a good pen color here. I don't want to use the brown. I don't want to use the pink. There we go. So if I would have gotten into this position, the 70 call for 75 cents on, I'm sorry, Tuesday, the day after earnings, and I set what you might consider setting on a stock, on a call, if I set a 10% stop on the position, well, the bid-ask spread alone might take care of that. All right, remember the first day we got in at maybe 75, well, the bid was at about 60. Well, 15 cents down, that's more than 10%. If my broker only looks at the bid, the natural bid on a long option, and is not looking at midpoint, I'd get stopped out of this position right away. 10 cents on an option premium is nothing unless you're trading price line, which might be $40 to $50 for an at-the-money option. But in general, the options we're talking about are going to be small price. So setting a standard stop that you'd consider on a long call or a long put of 10% or 12% is going to get closed out automatically or very quickly unless the stock really rockets up right after you get into it, with a long call, of course. So that's the trade-off. You really got to set a stop more to make sure that you don't get closed out too often. Okay, and what's wrong with getting closed out too often? Well, you're not allowing the positions to run. You're not getting a desired profit on the winners because the ones that might have rebounded, you were already closed out and probably didn't get back in. Now, Sam follows up with that. He says he likes to get out at 50 to 80% gain and 20% loss. Okay, 50% to the upside, of course, 20% to the downside. 20% is good with the weekly options because they can get away from you very quickly. When I talk to investors who do longer term options, especially for calendar spreads, their stop is closer to actually 50% down. They're willing to take a 50% loss because a hiccup day like yesterday, stock falls 5%, you might lose 30 to 40% on your long option. That's the lie of leverage, okay? Maybe 10% would give you closer to a 40 or 50% loss on a stock depending on which strike you selected. But again, that's what you have to watch out for, and that's a consideration. And why is something such as setting stops? We'd say, well, setting stops is a good idea because it allows you to control so you don't take 100% losses. There have been several back tests I've run on strategies such as naked puts, even the weekly naked puts and the weekly covered calls that Ernie has that we put up here for the covered call picks of the day and the naked put picks of the day. On the weekly covered calls, picks of the day, Ernie did not use a stop because when he put in a stop on the covered call, I know that's different than a long call or a long put we're talking about, but when he ran his historical tests with a 10% stop, he more than tripled the number of losers. Instead of having maybe 15 or 20 losses over a one-year period, it actually went up to closer to 40 or 50 of 110 trades. And the problem was those positions came down in the first couple days to where it hit the 10% stop but then rebounded, where the trade was actually profitable later on, even over a 1 week or 2 week time period. So sometimes the stops can get you out of the positions too often to where you can't be successful in trading. Stops are a good thing, don't get me wrong. I advocate using stops with premium generation strategies such as bull puts and bear calls. And we'll all see something later on this week, of course, later next week, I should say, where when I tried to use a stop for my bull put spreads that was very successful, it completely turned the track record around. And using a simple stop of not allowing the not allowing the stock to go below the short put strike price in a bull put credit spread, it actually turned a winning portfolio into a losing one. Okay, and yeah, that's kind of the gambit there. So it's tough. I know it's tough with using shorter term options because the management really isn't there. And as I mentioned, we saw it with TJX here. So let's talk about that one more time very quickly. Let's ignore the earnings. And let's say we got in, the 15th, the day after earnings. And we paid 75 cents for our 70 strike call. Okay? So let's just go ahead now. I'm going to go to the custom spread tool here. I'm going to take a look at the profit and loss for this position. There we go. All right, so let's say I'm going to the custom spread tool here. So I put in TJX, and we went ahead and bought the August 18th 70 strike call for 75 cents. We'll just do one contract, keep the math simple. So remember, this would have been on Wednesday, the 15th. Okay, so it's a simple call. We're looking for some simple profit on the position. Our max risk is whatever we invested into the trade. Probably would have done 10, 15, or 20 transaction as well. Okay, now two things we could have done. Sam just brought something up here. Two things we could have done. Okay, let me just remark on this. He said sometimes I have a stop and buy a put if the downside is strong. You're still in the trade like yesterday. Had a stop on my calls and would have been long puts. And that's an idea as well. It was long puts on SPY. But let's go to the forward to the next day on our history, on the 16th when it was up to 143. What are the two choices we had here when the stock's at 71.59? We could have closed this position. Probably would have. And we're at about 100% gain. I shouldn't expect much more than that. And you could say, oh, well, maybe you got greedy and you said, well, it ran $1.43 today. I'm expecting it to go up more. It could hit 72 or 73 by Friday. All right, so you're looking for double this. You're looking for it to go up to 73. So your 70 strike call would be worth $3. Okay. Well, what are the two things we can do? Well, at this point when it's rise, the 72.50 for August priced at about 15 cents. So I got to turn this into sort of a bull call debit spread by jumping into that 72.5 call and selling it for 15 cents at midpoint. Now this looks like a strong spread. It's going to show us a very high return off of a very low risk because we legged into it. But what happened in the next 3 days? Well, the stock dropped back down. We have a debit of 60. We'd probably get out for maybe 55. So we're only looking at a 5-cent loss. This wouldn't have been a bad play. And if it did go up to closer to 73, above 72.5, against the $60 investment, we could have made 190. But there's not a lot of premium here. Now, if the stock did gap up to 72, went up a little bit higher than what we saw, well, you could have probably gotten 40 cents for this, taken that down by half. Looked at a really strong return if the stock continued up and was above 72.5. What's the other thing I could have done? Well, I could have sold half of this and moved up to here. So let's say we have bought 10 contracts at 75. Now it's up at 155. If I sold 5 of those to take the risk down and then maybe bought the 72.50s or rolled up to the 72.50s, I might have had no risk on the trade and still could have profited if the stock continued to move up. Okay? Let's look at those two examples. We had 10 contracts at 75, so now we're risking 750. When the stock jumped up to 71.59, I could have, of course, sold these, all 10. Let's say we did this first. Let's say I sold all 10. That was it, $1.55, $1.60 is what I said? I could get $1.65 at midpoint. I'll put in $1.65 during the day. Okay, so now we've got a profit of $900 on the position. $750 invested, got $650 back, so we made $900 profit off of $750. Great return for a 2-day trade. But now, what if I just went ahead and bought on that same day 10 of the 72.50 calls? Whoa, for 15 cents. So I rolled up the calls. I still have a credit of $750. I'm in a long call that has a guaranteed profit of $750 because I only paid $150 to get back in. We had a profit of $900. And if the stock continued to move up, I could potentially make more. But if it didn't and it stayed down where it was, we still would have made $750. Now that's profit. Okay, that's not a wash. That's a full profit. Okay, we paid $750. Collected $16.50 when we sold to closed and only paid $150 back. So $750 profit is in our pocket. Okay, it's guaranteed profit at this point. So this is one way you could have done. You could have closed out all of the 10 calls on the day we saw the 100% return, gotten to a higher strike to leave the upside open, but still managed to profit. Okay, 100% profit. That's a play that I like because I can still take advantage of more if possible, but I'm guaranteed to make 100%. Remember, this is profit now. This is not an even swap. This is not break even. It's $750 of profit. That's one way. You could roll the call up once you've seen that 80 or 90% gain to have a guaranteed profit on the position, but still take advantage of further upside. Looks like a more attractive position to me than trying to create that bull call debit spread and only collecting 15 cents. Although that would have been a 390 some odd % return I think we saw if the stock did go above 72.5. What else could I have done? I could have sold half. All right, we could have sold to close half of this position. Give us a weird little profit and loss chart here. But essentially, we've pocketed $75. So what do you have? You still have 5 long calls at 70 that you essentially have a credit. Okay, you essentially paid you were paid 75 cents. You've canceled all of the risk. Now, of course, I could take that back and buy 5 calls at the 72.5 on Wednesday for 15 cents. Now it's going to take away from some of that guaranteed profit. In fact, almost all of it. But now I've kind of got a laddered position. I've got 5 calls at 70, 5 calls at 72.50. I took the profit off the table. So this is effectively no cost in the position with infinite profit. But it didn't guarantee me a profit to the downside. Okay, rolling up the call would have done that in this scenario. Laddering, selling half and buying 5 at a higher strike would have done that. Or, by the way, just selling half itself, that's a good, what you essentially have here is 5 70 calls remaining at a credit of 75 cents. That's not bad either. You still could have got 60 cents today, so it would have been $1.35. But remember, if I had rolled up to the 72.5, if I had closed all 10, we netted a profit of $7.50 right off the bat. Okay, so we had a $900 profit, bought 5 or 10 more calls at $72.50 to get further upside, but we still would have profited 100%. So I kind of like that move better, rolling the call up. If I still have 3 to 4 days left, and I've already seen a 90 to 100% gain, maybe a little bit more on the call. To lock it in, to have no risk on the long call, still unlimited upside. Okay, but I'm not a fan of the laddering idea. You know, selling here and then buying more. Some people don't even sell. I know some educators out there teach the long call or long put laddering, where I might have bought 5 here, and as it moved up, I would have bought 5 at the 72.5, and if it kept going, I might have bought 5 at 75, and so forth. They're not closing these out to realize the profit. The risk there is that if it pulls back down, drops again to 70.47 or below, you waste the 72.5 and the 75 calls. They're gone. Okay, you don't have any value there, and this profit is probably negligible at that point because the other cost basis of the options you put in that did expire worthless. Okay. All right. So, yeah, the long calls are a little bit tricky. We do have a full presentation there on the managing long call positions, managing long options, and of course, as always, my apologies, if underneath the main home tab you go to free webinars, you have a variety of sections here, the power options tools, options strategies, options concepts, and the requested topics. But I go to options strategies here, and there's a full webinar on managing your long options, managing techniques for long calls and long puts. I'll be honest, this webinar does focus more on longer term buying calls and buying puts, say 2 months out, maybe even 1 month out, maybe 6 months out. But the concepts can apply to the weeklies. The one management technique, as we mentioned, that's lost is you can't really convert it to a calendar spread to try to lower your cost basis with the weekly option because you don't have daily expirations. Yes, SPX now has every week a Monday, Wednesday, and Friday expiration. I joked with Ernie 6 months ago that I'm just waiting for the day when all options have daily expiration cycles. Then we saw the Wednesdays and the Mondays come out, and I said, oh, wait, they're actually trying to do this. So I think in the next 2 years, the top 10 that usually got the weekly options first and then got the 5 weekly. What do I mean by 5 weekly? When weekly options, let's just go to Apple real quick. When weekly options were first introduced a few years back, let's look at calls again to make the chain a little bit easier to see. We ended up in these cycles, okay? And what it was is that you just had the next expiration available when the weeklies came out. So on the Thursday before Friday, so yesterday, any stock that had weekly options, the 825 series would have appeared on Thursday morning, okay? That's how it was originally done, 1 week at a time. But then, as you saw, these 5-week cycles started to come out. Okay, so at first, it was just the top 5 and the top 10 that had this multi-week series available. So anytime you looked, you could go 14 days out, 21 days out. Even though it was standard expiration, you could still use it. 28 or 35 days out in time, and if it fell close to another expiration, you'd have maybe 6 in a row that you could choose from. You know, here we have 6. 1, 2, 3, 4, 5, 6. All considered weekly options. This is a standard expiration, but once you get to this point and you're trading this at 10 days, 7 days out in time, it's considered a weekly option. Right? But what do I mean by these top 10? Well, originally when the weekly options were released, it was available on SPX, and they were playing around with one of the other indexes at the same time. And then, of course, SPY had to have them if SPX did. But then the big names came out. They were the next series that were allowed to have weekly options, just that 1 week out cycle. And it was Apple, I believe. Well, I know it was Apple was one of them. Bank of America, Citigroup, I'm pretty sure it was BP at the time, and I forget the 5th one. I can go back and look there, but I forget what the 5th one was. Those were the first securities to offer weekly options. And about a month later, another group of 5 came out, and then another. And by the end of a 3-month period, they started releasing more at a time. 20 to 30 were coming out at a time, but they were still only 1 week away. Once this got up to about 250 securities that offered weekly options, that's when the 5-week series started to appear. But again, it just appeared for SPY and SPX first, then the first 5, and then the next group, and then it kept escalating. 3 years ago, 3 years ago, there was probably about 350 to there was about 400 securities that offered weekly options. And it was about 2.5 years ago where only half of them had the 5-week cycle and the other half had the 1 week out cycle. Now, I think it's all of them. I'm almost positive that 100% of the 490, 400, and maybe close to 500 securities that offer weekly options, 100% of those are at the 5-week series. I don't see them expanding too much recently. It stayed right around this 480 to 500 number for a while with the 5-week out series. But SPX started that Monday, Wednesday, Friday. I'm not going to be surprised if in 3 or 4 months, I haven't seen anything on CBOE or the exchanges or any of the people I talk to in the industry that it's coming. But it might not, it's not going to surprise me if in 2 to 3 months, Apple's going to have Monday, Wednesday, Friday. Bank of America would have Monday, Wednesday, Friday, Citigroup, BP, and whatever the 5th stock was that I can't remember. I think they're trying that out. After a year or 2 of that, if that's the route they're going, it's not going to surprise me if SPX and SPY, maybe a year or 2 down the road from now, maybe less, but I'd say about a year, maybe a year and a half, if we start seeing daily options. You have an option expiring Monday, Tuesday, Wednesday, Thursday, and Friday. Programming nightmare. Thank God I'm not a programmer, I'm an educator, but I still got to make it useful to tell you guys, ladies and gentlemen, I should say, so that you can understand when you're looking at an option chain, what is a Monday, what is a Tuesday, what is a Wednesday. We'll see if we get there, okay? But it's not going to surprise me if we do get there. All right. Okay, I'd mentioned this actually in the beginning, and it is a question that came in. James? Oh, okay. I'm sorry. It's J. I think he entered his name as Jimes. So he probably goes by Jim or by James. That's no problem. Okay. So James is asking about a feature on power options that we have called the morning update / PriceWatch Alerts. Let me go ahead and add covered calls here for this conversation. Okay. And what I have to do first is I'm going to go to Home on the trial account. I'm going to go to Learning Center. And here we have things, our quick start guide, where you can schedule a coaching session as a trial member or a subscriber, the various tip sheets, tutorials, webinars, which you can access directly. I need to go to Priority 1 Email Archive. And what is this? These are the archive listings of what we call the morning update / PriceWatch Alerts. This is a feature that is sent out to our trial members and subscribers. And it's run by a third party that we sort of partner with. They take their covered call criteria, put it into our patented covered call search, and every morning they send out the top few covered calls, the PriceWatch Alerts, showing covered calls for different securities. So for example, here's one for Ferrari, where we could have bought Ferrari today at 110.94 and sold the 110 call September 2013 for 339. Okay, so you've got a debit of 107.5, and it gives you a reasonable return of 2.27 for standard September expiration. Okay, and there's others here on Norfolk Southern and so forth. Okay, the stock's at 110.94. This is showing a 110 call. Norfolk Southern's at 120.43, and we're looking at a 120 call, pretty much at the money, slightly in the money here. But the question comes in from James is, why would anyone sell an in-the-money covered call? Why do I want to give up my stock essentially for less than what I paid for it? Aren't I losing money? Well, the answer is no. Okay, and you can see that here in this number, but we're going to take a better look at it graphically. So one of the PriceWatch alerts on race is 110.94. And we could sell the 110 call for 339. So am I losing money because I'm selling a call below the stock price or what I might have paid for the stock? Absolutely not. Yes, I'm 94 cents below my purchase price. So if I got into race, into Ferrari at 110.94 and I sold the 110 call, I'm giving up 94 cents, but I'm getting paid $3.39 for that option premium. So if I get assigned at 110, the stock's trading above 110 on my covered call, this is 110 here, sorry. Remember, my total cost per share is 107.54. So my profit is still going to be $2.46 on the position, which is the 2.27%. It's still going to be a profit even though I'm selling a call below the stock price. Okay, well, wouldn't you make more money if you sold the 115 or the 120? Well, yeah, your percent if assigned, potential percent if assigned is going to be much higher, but your probability of getting assigned at 115 or 120 is going to be very, very small. Okay, so let's go back to the option chain and let's take a look at the current values for the Ferrari position. And we'll just look at standard September expiration. Okay, the price has changed a little bit from where we saw it the other day, but here we're seeing a price of 111.53. Just a little bit more in the money. Why would I sell the 110 call? Probably be around 395 at midpoint. No, I'm sorry. Wow. Be $4 even at midpoint. Friday math, huh? So we could sell to open this at $4. Yes, we're selling a call that's $1.53 below the current stock price, but we're getting $4, so that would still give us a reasonable profit on the position of, again, just about the same, about $2.47, or 2.1% return if assigned. We'll say, why not sell the 115 call at 150 or 160, where you could potentially make 4.5% return? Well, you're right, all right? But that return is not based on the premium. The 4.5% return is based on the additional $3.47 to 115 plus the 150 to get you to 4.5%. But there's only a 28% chance the Ferrari will be trading above 115 in the next 28 days, and you'd get assigned and make that 4.5% yield. We got about a 60% chance of making the 2% return with having a 3.4% downside protection. What does that mean? If I enter the covered call at the 110 strike, I'm going to collect $4. That means the stock can drop $4 before I start losing money on the position. If I sell the 115 for $1.60, well, of course, now I've only got $1.60. The stock can fall. It could fall back to about 110, and I'm starting to lose money on the position. That's the downside protection. As you go further out of the money, yes, you could make a higher percent return if assigned. You have a lower probability of getting that return, and you have much less downside protection. Okay? Now, I'm not saying you should go deep in the money and that you should look for a 10% downside protection, and for a 28-day trade, only get a 4.4% return with a 98% chance of getting that. I don't think that's a good trade either. Okay. And by the way, I don't think the 115 is a bad trade. I don't think the 110 is a bad trade. The 105 might be a little bit too low for my taste. 1% for 28 days. I can usually get that with a weekly option with a stock with a little bit more oomph, a little bit more volatility. And the 120 is just a little bit too far out of the money. Okay, it's 40, 50 cents. A little bit too far out of the money. So I'd say in here, but really the 110 and the 115 are probably the best choices. Now, is the 115 a bad trade? I just spent a couple minutes saying that, yeah, you could make 4.5%, but there's a small probability of getting it. If you're long-term bullish on Ferrari, okay, and you want to own the stock, but you want to lower your cost basis on a consistent basis, and you don't want to be assigned necessarily because it's a core holding in your account that maybe for tax purposes or some other reason you don't want to risk getting assigned, the 115 is a decent play. 120 is also a decent play. I mean, if you think about it, it's only 40 or 50 cents, which is only 0.4% against the current stock price. But if you did that month by month, you're essentially getting 50 cents dividend every month, okay? To be at the 120 to try to avoid assignment and continue to lower the cost basis. But on a $100 stock, 40 cents, you're barely reducing it by $1 every 2 to 3 months. Okay, it's a little tough. So, which is the best covered call? It depends on your goals. To me, I'm probably here. At the money, slightly in the money, reasonable return, 2% for a 28-day trade is a pretty good return for a 20-25% volatility, okay? 3.5% downside protection. The stock's going to fluctuate over the entire 28 days, I know that, and above a 50% probability of getting that return. That's more conservative to me. That's not as conservative as only getting a 0.9% return with the 105 strike and having a 7% downside protection, but still. But if your goal is long-term hold, and maybe you are slightly bullish and a little bit more aggressive, the 115 is the good strike too. And that's probably better than the 120 in my opinion, okay, the 115 strike, all right? David says, doesn't wash sales come into play if assigned? Yes, but what I was talking about for tax purposes, okay, and I have a lot of people, David, that come to me with this situation, power options, new members, even old members. What I was talking about the tax consequences with being assigned is, let's say you're trading Ferrari in a cash account. And yes, the stock's at 111.53 and you're trying to consider which call to sell, but your cost basis, because you got in 3 years ago, is actually $48 per share. Okay? So if you sell the 110 call and get assigned at 110, and let's say you had 1,000 shares or maybe 2,000 shares, there's a very high profit. And that wash sale rule for the covered call doesn't really cancel that. Okay, I was talking about if you have a much lower cost basis on the position due to previous adjustments or it being a core holding in your account for many years, averaging cost basis and so forth. So if you're looking at it as not a new position, where you're right, David, that does come into play. I'm not talking, I wasn't referring to it as a new position. If I refer to tax consequences, I'm talking about something that you've had for years and years. I still get phone calls occasionally from people with after all the splits and all the adjustments. Gentleman had a shares of Apple whose cost basis is down to $19 per share, and he had 7,800 shares of Apple. Okay, through all the splits, through all the averaging down, his cost basis was around $19, I believe. Selling calls against it, doing other plays. Sometimes, I think in 2008, actually, I believe he had multiple puts against it during the recession. So he pocketed a lot of capital insuring his Apple positions before the fall, and then once or twice more when there were little hiccups in the market over the last 2 years. So yeah, $19 per share. He does not want to sell it. It isn't a cash account. It's not in a protected account. He does not want to sell that position. He does not want to get assigned. He's very hesitant to sell multiple calls or at the money covered calls against Apple right now because of the potential tax consequences. Okay, so that's just something to consider. But when we're talking about covered calls, again, sorry, not to get sidetracked, but with the covered call position here, these are both good selections, but remember, you've got to map out your trading plan. okay, and decide, is it worth it to only have a 0.4% protection, generate 50 cents of income, where you could make 8%, but you only got a 10% probability of getting that return? Or is it better to go maybe slightly in the money, have a better probability of maybe making 2% over a 28-day period while still having 3.5% downside protection? I kind of like that view. Those are the kind of combinations I look for in collars. Of course, with collars, I don't look at downside protection. I look at the maximum risk, because I'm guaranteeing that I have a floor on the position, unlike a covered call, or even unlike a covered call with a stop order in it as well. Neither one are bad positions. Don't get me wrong, the 110, the 115, possibly even the 120, if your goal is to generate income long term and not be assigned. Okay, hold it for a long term and collect a dividend like income month by month, but not be assigned. So it's a good play as well. Okay, but you've got to decide your combination, okay, and what works best for you. Oh, yeah, Sam, where I was going with this, sorry, before I get off on that topic, Sam, where I was going with this is that that's what the PriceWatch Alerts are. We send out those emails every day, and of course we archive them, so you can come in here and look at them as well. But again, it's compiled by a third party. They use our search tools, they send it to their customers, and they send it to our customers as a bonus as well. It gives you some trading ideas, but this is a perfect example of what I encourage my power options customers to do with the PriceWatch Alerts. We see Ferrari. We see 100 shares of this at currently around 110, might be too rich for my blood, whatever, but let's just say we're interested. And I see the September 110 call for 339. And we saw we could have about a 2.1, 2.2% return and about a 3.5% downside protection. But James, the question you're asking is perfect. That's what I want you to do with this listing. Say, well, what about the 115? Why aren't they showing me the weekly that was available? Because Race offers weeklies. Why are they showing me this 1 month out call? This is what I want you to do with the PriceWatch Alerts and the morning updates. These aren't, for me, I would never call these recommendations or suggestions. I want you to look at this and say, okay, I've never traded Ferrari before. I kind of like the price. This looks like a decent return. But what about the 115? What about does it offer weeklies? That's exactly what I want you to do with this. Get that email, see it in the morning, see some ideas. Log on to Power Options. Go to the option chain and say, okay, now here's my 110 call with a 2.1% potential return if assigned and a 3.5% downside protection and a 60% probability. Here's what the 115 would give me. All right, let me use the more information. Let me look at the stock chart. Does this look like something that's bullish that might go to 115? Does it look like something that might be, I don't know, a little bit iffy, and maybe that 110's a little better for a little bit better protection? Or look at the dates. Hey, this has weeklies. Maybe you go 2 weeks out instead of 28 days. What would the 110 look like 2 weeks out? Well, hey, this looks this looks pretty good. I could go with the 111, not as much premium, but for a 14-day trade, I'm getting 1.6% return if assigned instead of 2.1 for 28 days. If I can do this in 2 weeks, get 1.6%, even 1.3% with the 110, if I can get that every 14 days, over the next 28 days, I'd have a 2.6% or 3.2 instead of a 2.1. That's looking pretty good too. Shorter time frame, offers weeklies, okay? That's how I want you to use the PriceWatch Alerts. And a follow-up on that, we, Ernie, myself, Power Options, Greg, the Power Options staff, all of us, but me and Ernie, myself, we don't track the PriceWatch Alerts in the morning updates. We've never run testing on those. I've never done any kind of extensive research and tracked them for a 5-month period. And part of the reason why is because I can tell you with confidence what the track record is now for a 1 or 2 year period for the covered call picks of the day that Ernie put together. Okay, actually the 2-year time period return on this one from June 20th, 2015 to June 29th, 2017, if you followed sort of Ernie's rules, take the top 3 trades on the picks of the day, and I believe use a 10% stop order, I believe is what he used, is this if the stock fell, that he would get out if it was a 10% drop in the stock during the trade. On these weekly positions, the return over the 2 years was 63%. Okay, the 1 year return was about, I think it was close to 38 or so. So the second year wasn't as much because there were 2 more drops actually in the last year. If you think about it, there were 2 more significant drops which had an effect on it. But the 2-year testing return following the rules that Ernie did was 63%. The weekly picks of the day over the same 2-year period, the weekly covered call picks of the day, where you're going 1 week out and slightly in the money, was a return of actually around 170%. That's just taking the top 2 trades for the weeklies. Believe it or not, it was 170% return over a 2-year period. It was 58% or 48%, I think, in the first year, and then it compounded, of course, because we used the compounding in there as well. Sometimes there's 3 trades. If you did 3 trades with the weekly picks of the day, every time 3 trades came up, the return was 140. It was lower than only using the top 2. It was interesting, but it was lower than only using the top 2. But the top 3 was around 140% over the last 2-year period. So I have confidence in these. I'm not saying I don't have confidence in the PriceWatch Alerts, but I don't track them. Ernie and I tested these, and this is where our focus is, that we go with confidence for the covered calls instead of the morning updates. But again, what do? You get the morning update. You see a trade. James, you're asking the right questions. Why would I sell an in-the-money call? Or why am I going 28 days out? This is a trade idea. The structure now of the covered call is up to you based on your trading plan. When you say, I would like to go, in your mind, you're saying, I'd prefer to go shorter term if it was available, and I'd maybe like to be right at the money or a little bit out of the money. And you go to power options, you go to race, you take a look at the call chain, and now you can compare immediately with weeklies, 2 weeks out, standard expiration that they were pointing to. What's the comparison? Even going just 1 week out to August 25th, what's the comparison of the 111 or the 110 at the money with only 7 days to expiration versus 28? And Sam, he's not a cover call trader. He says, what about a bull put on race at the 105, 100 monthly? Well, what about a bull put on the weeklies too? But let's take a look at Sam wanted to do for September. So I saw race in the PriceWatch Alert morning updates. Say that covered call is not for me. They must have some kind of thing that they use proprietarily, our third-party partner that they use proprietarily to do a spread. So let me go ahead and what if instead of buying the covered call, or doing a covered call I should say, we take the 105. Sam, let's go ahead and call that 95 is too much. I'm going to call it 90. Okay. One contract. All right, so the 105, 85 bid, $1 ask. Market maker wouldn't give me 95, but he might give me 90. And then the 100 put at, we'll call it 40. It's pretty decent. This is about as standard as an example as I can give you. What do I mean by that? Most of the time when I do a webinar, I forgot to add the 100 call, or 100 put. I'm sorry, folks. Let me try that one more time. Fantastic. There we go. When I break down a spread position, which I'm going to be doing next week, we're going to be talking all about spreads next week, but on the Tuesday presentation, that's the sort of introduction, credit versus debit spreads, I'm probably going to use this as an example. Why? Because the math is simple. Usually what I do is with the famous, everyone knows it, the famous XYZ trade when you're seeing a new trade example. Well, for a bull put, I might sell this at 1 and buy this at 50. So we get a 50-cent net credit here on a 5-point risk. You can't make the math easier than that, in essence, okay? It's 11.1% return, very common. It's probably, we saw in that range, though. And 105 is about an 86.7%. That's pretty good. 86.7, I'm sorry, probability the stock would stay above that strike price of our bull put credit spread to be profitable. But yes, it's a 5-point spread, but remember, you keep the 50 cents. The most you can lose is $4.50. Okay? Now this is a 9-to-1 risk-reward ratio, isn't it? I'm risking $4.50 to potentially make 50 cents. It's a 9-to-1 risk-reward ratio. That's what you expect to see when you're looking at probabilities of 85, 87, 90% above the short put. You get a better premium at the 110, 105, but you only have a 60% probability. So that's the trade-off, okay? Now, Sam, of course, is talking about you could do a different way with this, of course, and we talked a little bit about that last week, or 2 weeks ago, I'm sorry, I wasn't here last week, but if the stock runs up to 115, you're going to have a 200 to 300% loss. This little 110, the stock keep going, 400 it bought it. Okay, yeah, it's he's saying the bull puts the reason behind the bull put spread rather than the covered calls. If the stock runs to 115 in our covered call, I make the premium, but I miss out on the $5 profit. Yeah, because I sold the 110 call, you're right. But in the bull put credit spread, of course, you still have a capped gain, but you're using leverage. So instead of a 2% yield, you're looking at an 11% yield, but you're also taking a 9-to-1 risk-reward ratio. Race falls to 99. It's about an 11% drop. Okay? Well, actually, it's just about a 10% drop on the position. The covered call, remember, you collected a $3 premium at the 110 strike. So if the stock fell to 99, your cost base was 107, you're only down $8 or about 8% on the position. Okay? And if you're in a spread and it falls here, you're at 100% loss of whatever you invested. That's the lie of leverage on both sides. As Sam says, the spreads have a 9-to-1 always. Yeah, if you're in that probability range that most spread traders would look at. Let's take a look at race very quickly in the bull put credit spread, Sam. But I'm going to go ahead and keep it to September expiration and look at more results to start with. Now, as you go, what I'm bringing up here is as you go less and less out of the money. So here's our position that we were just referring to. Oh, no, that's the 105.90. Oh, here it is. I'm sorry, 105, 100, 87.6%. This is showing a 40-cent net credit, so it's really a 10-to-1 risk-reward ratio, a little bit more than that. Okay? But if I go with the lower premiums, I could go with that 110, 105, get a 115 net credit. Okay? So that means I'm taking in 115 on a 5-point spread, so my true risk is only 385. So now I'm really at close to a 3.5-to-1 ratio, okay, at a 60% probability, though. Okay, so when you go to the 87, 90% range, exactly, Sam, when what makes sense to you and me, you and I should say, and most spread traders probably, is I'm going to start off with a minimum requirement of going out of the money, looking at about a 75% probability, or what might equate to a 0.3 delta, which is another way some, I know, spread educators teach the bull put and bear call credit spreads. You want your short option delta to be around 0.3, which equates to about a 70% probability. Well, I start at 75% above on my positions, but the ones I trade are usually about 78 to 82% probability. You know, I could filter my results further by using that in the search. Again, for bull put credit spreads. But anyway, the percent probability that it would be above the strike price at expiration. But yes, Sam, when you and I are in our range, 75, 78, 80, 82, we're talking 8-to-1 to 9-to-1. When you get up into these odd 98% probabilities, selling the 100, that's 10% out of the money, and buying the 95, you're making a 5-cent net credit on a 5-point spread. So you're making $5 to risk 495. Okay, you're at about an even 1% return. But if something catastrophic happens and the stock falls below 95, maybe not likely to happen in the next 20 days, but it pops down below 95, look at that. If this was your whole strategy, this was your whole structure, to make a 1% yield on a 28-day trade, to have a 95% probability or more, you enter 100 trades in the year, one of them goes against you for the full loss, you've just wiped out 100 trades. That's the risk reward we talk about here. That's the lie of leverage against us, okay, with the spread trades. All right. Sorry, Yatish, okay, popped in a question. He's watching me talk about covered calls. He's watching me talk about structure, and he's watching me talk about spreads with a probability, and I'm just picking strike prices randomly, and all I'm doing is comparing the numbers, which is important. You know, we're looking at the return versus the probabilities, the risk-reward ratio. The higher the probability further out of the money, the higher the risk-reward ratio. Okay? The lower the risk-reward ratio, the less likelihood you have of getting the full return. That's your trade-off. Well, of course, there's a lot involved with options investing, and Atish is asking, do you try to see the interest in the trade for the strike levels of either the buy or sell? Okay, we're talking about open interest and volume. Yes and no, okay? This is just an example, one stock at a time, to show comparisons of what I would consider possibly an unreasonable or not likely bull put spread, one that I wouldn't trade. They would be out here. Okay, these ones I'm probably likely to focus on, but again, they come with that 9-to-1 risk-reward ratio or so. But I haven't gotten into the actual research and analysis of would I open the spread or not. So yeah, Tish, yes I do, okay? I do pay attention to the open interest and the volume when I'm opening a bull put credit spread. But I usually don't go in and look for a bull put credit spread one stock at a time as we did here. I'm showing this as an example to illustrate that risk-reward ratio as well. Now, what I'll do is I'll go into bull put and I'll go into search. Okay, and I do have requirements on my spread positions. It's minimal. You probably have a much higher one, but I do have requirements for, you know, here's the short option volume. You see all the contracts that came up with the exception of WIBO. Jeez, that's weird. Doesn't have any option volume for the 1st of September 86.5 strike. It's very interesting. Okay, but typically, Yatish, what I'll do in my search is I have a minimum requirement. This is a default search. This isn't mine, okay? We're on the webinars page. We're looking at weekly bull puts. But in general, what I'll do is I'll look for an option volume today of at least 5 times the number of contracts I'm planning on trading. So if on average, the bull put or bear call spreads in my portfolio, with a portion of my portfolio that I trade bull and bear call spreads with, let's say I usually average around 7 to 10 contracts, my option volume today would have to be at least 50, and then I want my open interest to be at least 10 times the number of contracts I'm planning on trading. All right, so I'll just plug that right into the search. We know we're going to lose at least WIBO. We're probably going to lose a couple others. Might not have any. No, we do. Okay, so Tesla comes in and Apple. Now, these aren't my exact search requirements. This is where I'm going to start, by the way, with that default weekly bull put. So we're going to make some changes next week. And during our whole spread, the whole slew of our spread education next week, in the middle of it on Wednesday, we're probably going to be releasing the search we're back-tested and most confident with for the bull put weekly picks of the day, which is very similar to what's already here in the weekly bull puts with a couple of tweaks, but you'll have a weekly picks of the day for bull put credit spread, and then shortly after that, within the next week or two, you'll have one for bear calls also, in addition to the weekly picks of the day for covered calls and weekly picks of the day for naked puts. I don't think I'm going to do a monthly bull put or a monthly bear call, but if I find a criteria set that goes long term, monthlies, I find a criteria set long term that outperforms the weekly bull puts, I'll put it up there, but so far I haven't. I think the weekly bull puts is the way to go. But yeah, Tish, that's what I'll do when I'm looking for a bull put. I'll look for the types of stocks I want, the fundamental and technical criteria I want, minimum net credit, minimum probability, and minimum volume and open interest. Now, if you prefer higher, you want an open interest of at least 1,000 and an option volume today of at least 100 contracts or more, that's fine. Probably not going to filter out. What's really filtering the results here is not the volume I'm putting in, and it's not the, oh, it did just remove it to Apple, so Tesla is not as active. That's the danger, by the way, of the option volume today. Remember, it's just the amount of contracts that were traded today. On Monday, this is for the 14-day out series. On Monday, these will probably have more volume. Today people were more focused probably on closing positions, or they'd already rolled positions. There might not have been that much activity today looking at new positions 14 days out. Okay. What's really killing this, and I'm glad it's killing it, is this factor. In every search, you could screen specifically for stocks that do or do not have an earnings between now and expiration. In my credit spreads, covered calls, naked puts, and so forth, I don't want earnings between now and expiration. I don't want the surprise to just suddenly drop down 20%. What was that big mover yesterday? It was a shock to me. Foot Locker. It was today, I guess, wasn't it? It's down about 15 points, 20 points? 15 points, yes. It was down about 28, 29% Foot Locker. I didn't trade this one. I traded a long straddle on Foot Locker last earnings cycle that was successful, but man, I did not think that this was going to have a 28% drop. I had good profit on Coach and Urban Outfitters. I was trading some of the brick and mortar retailers, and I just didn't think Foot Locker was going to surprise much one direction or not today, but man, did it ever. That would have been a fantastic trade. I didn't do it. I should have done a long straddle. Let's take a look at what it would have been 2 days ago. So yeah, it's a 34. So 2 days ago on the 15th or the 16th or the 15th. I'll go to the 15th, although I probably would have opened it on the 16th, to be honest with you. But the 15th, man, the stock was at 47.13. I would have bought the at the money, I know. Yeah, I'm going to expect some volatility crush, but you know, that's sort of the lottery tickets here. You play with these straddles. $2.10 for the 47 strike call, I'm sorry, and $1.95 for the 47, so that would have been a total debit of $4.05 into this position on Wednesday. And I don't want to look. It's going to be depressing. August 18th, yeah, let's go to large chain, 47 put, geez, 1265. All right, so we would have made $860 profit on a $400 investment. Well, or you did 10 contracts, so a $4,000 investment. Could sell to close it today for around $1265, so netted $860 in 3 days. That would have been a good straddle. You can tell I regret that one. I regret not doing that one. I was in 2 others that didn't work out as well. They're both profitable at the end of the day. One just barely, and the other one was too much. Okay. Yeah, Tish, I'm sorry. Let me go back. I didn't see your question until just now. Let me go back to that bull put search we were looking at here. Yeah, Tish says, could you search for risk reward of 20% and over? Yeah, you can. That's what the return is. Okay. The percent return here in the credit spreads is defined as the net credit you receive divided by difference in strikes minus net credit, or what we call the true margin. See, some brokers, if I did a 5-point spread, they're not going to charge me the $500 total to put on the trade per contract. If I get 50 cents, they're just going to charge me $4.50. Okay, so we saw here, what is the risk-reward ratio? Well, again, my net credit on the example we looked at, that perfect example we came up with on Ferrari, was 50 cents to, by our definition, difference in strikes minus net credit, $4.50. Reward to risk, which was equal to 11%. So I want it lower. You want a 20%. That's what you put in as your minimum requirement to percent return, because it's net credit, the potential profit, reward, divided by the margin, the risk. Okay? Now, in this search, I'm not going to find anything. There's 2. Okay? I'll put in 19. But remember, the WIBO one didn't match the volume that I wanted. Okay, so I put in 20. I put in 19, so WIBO would appear it's right at 20. But let's go ahead and do 19% Yatish here. Those are the 2 spreads that match my other criteria, of course, that have the risk reward you're looking for. The 20% return or 20% risk reward. Right? All sorted down for me. 2 potential options, Tesla and WIBO. Okay? All right, so that's That's the factor to use there, okay? And Sam was talking about a bull put he had. His bull put on Tesla today was the 335, 330, good at 347.46. So yeah, oh, it still dropped though today. Nice drop. Okay, so but yeah, your bull put was still expired, worthless, and still in that position. He's $20 out of the money every week on Tesla, and an equal number of puts as well. Yep, the close of profit of yeah. So he's just talking about the positions he closed on Tesla, and he's been following it with about 20 points out of the money for spread positions. This one had that 4 drop today, so it would have been at 350. Oh yeah, there's your 335, 330. So 350 today. I'm sorry, before the market opened with a drop, 351, 352. So you're right at that 20-point mark as well. All right, well, ladies and gentlemen, it is 5:45 or 5:42 really p.m. Eastern Time. I don't have any new questions coming in, but if you have any last-minute questions, I'm going to encourage you to send those to us as well. You know, just in the end of the time here, and just wanted to remind everyone, of course, what do we have coming up? Well, next week is what I was talking about with that full week of spreads education. Tuesday at 12 noon Eastern Time, hosting a presentation on debit spreads versus credit spreads. This is an introductory level. It's a 100 level course if you're thinking about it like college or you know, a class structure. What I'm really doing is comparing the structure of a debit to a credit, why we do one over the other, and of course focusing on what are the outcomes of each at expiration. Because it seems like a lot of investors are still unaware, or they seem to get confused by the fact that if I opened a bull put credit spread or a bull call debit spread, a potential outcome of both of those spreads is I could end up being long stock if I don't pay attention. Just because you're trading a spread does not mean that you have removed the rights and obligations of selling a call, selling a put, buying a call, or buying a put. Those still remain. And a potential outcome, if you don't pay attention, of a bull call debit or bull put credit is you might end up owning shares of stock. A potential outcome of a bear call credit or bear put debit is that you might end up being short shares of stock. Something to watch out for, but we're going to really talk about that, the debit spread, credit spread comparison, parity trade comparison, dangers and risks of the outcomes at expiration, what to remember, what not to remember. Then Wednesday at 12 noon, we're going to get nitty-gritty into the criteria, concepts that Ernie and I have experienced through backtesting, and what we've seen that can really help you be successful with credit spread trading. Thursday at 12 noon, we're going to talk about management techniques, the 4 vertical spreads, managing a credit spread or a debit spread. And of course, Friday, as always, we will have an open discussion, but this is the first time I've ever done this. The open discussion next week is going to be geared mostly towards spreads. I'm going to have that little caveat in there that we're really going to only try to take questions on spread trading and review questions that came in from our webinars over the last week, okay, as well. Now, spreads of wide term. These presentations here are mostly going to focus just on the 4 vertical spreads, but this open forum here is going to be really about any spread. Ratio spreads, questions on calendar spreads, bull puts, bear calls, iron condors, butterflies. That's what we're going to kind of focus on here, okay? Anyway, so that's what's coming up. If you're interested in any of these topics, just remember, at any time, just go to our webinars page. You can go to the main Power Options page, but go to the webinars page. I'll send everyone the link. It's poweropt.com/webinars.asp if you haven't done so already, okay? And you see our recorded webinars are here, but if you click on Watch Live Webinars, you'll be able to register for debit spreads versus credit spreads, the 100 level class, our 200 level class, how to be successful with spread trades, the 300 level class, sort of managing your spread positions, and then our open forum, open topic on spread positions on Friday. So you can register for those at any time. Just go to poweropt.com/webinars.asp. I'm sorry, folks, there we go. Okay. And once you're at poweropt.com, webinars.asp on our webinars page, click the blue button here for Watch Live Webinars, and then you can register for those 4 upcoming presentations next week. Okay? All right. Okay, so, but if you're looking around for other free material or other free information, that's perfectly fine too. Just remember, of course, you can check us out. Check out the blog, blog.powerop.com. Just mentioned the webinars page where you can see the archived webinars on different strategies and the Power Options tools, as well as register for those live webinars also. Of course, you can always go to our YouTube channel at Power Options to see some of those presentations as well. And if you haven't done so yet, you want to see or use, I should say, take advantage of the tools that we showed today with that search tool. We did the custom spread. Didn't really show the portfolio tools today. We showed a couple others. Remember, you can test out Power Options at any time. First name, last name, email, address, just plug that in. You'll get a free 14-day trial to Power Options. You'll have access to the site for 14 days. We are a subscription service. We have multiple levels of subscription. After your 14-day free trial, we offer an end-of-day service, which is $40 per month. Data is only updated at the end of the day. Most popular service is probably the 20-minute delayed service. So it offers access to all of the search and analysis tools and more, and that's $60 per month. But every time you are looking at the search results or running what-if scenarios or more, you're probably seeing 15-minute delayed data. We do offer a real-time service. That's $120 a month, mainly because the exchanges keep raising their fees for real-time redistribution. So why does it jump from $60 to $120 for real-time? It's because we get charged extra for any investor who we redistribute real-time data to. Okay, that's why it has to be that way. I do apologize, but that's the nature of redistribution of data. Now, what is this historical service? Well, those historical tools we looked at today, where we showed you a brief 1 month or 2 month back, we only went a week back, but you could go 1 month, 2 months, or 3 months back in our historical searches in the different strategies of the historical option chain. Okay. Our historical data actually goes back to 2006. So if you wanted access to the historical data, you could upgrade from the 20-minute delay to the historical service to add the historical and back testing, and that's $100 a month, so $40 more, because the 20-minute delayed service plus access to historical data back to 2006. And if you're on real-time, well, the premium service, you can upgrade to that. It's $160 a month, so you get real-time service and access to the data back to April 2006 as well. All right. Well, I didn't see any other questions come in. Sam says, I'm sorry about that. Michael says, thanks. I learned a bunch. Thank you, Michael. Sam mentioned we never talked about UXY. Yeah, it had a 30% move this week. Had some really good trades with high risk. Yep, the VIX, I had a couple of deep out of the money long calls on the VIX. Not many. I think it was 8 contracts, 1 5 block, 1 3 block. Out in time, and of course on Thursday they all turned profitable, extremely profitable, so I closed out of those. But yeah, a lot of times the VIX doesn't move, you're just sitting there waiting, and then pop, you get the pop, you get out of it as well. But if you think of any other questions over the weekend, remember you can send me an email at any time to support@powerop.com. Those of you who are doing the radioactive trading techniques, remember you can send me an email to support@radioactivetrading.com at any time as well. You can also call us during office hours. Ernie and myself are always available. You can reach us at 302-992-7971 during market hours. And of course, if you are a current member or subscriber, remember you can schedule one of those free coaching sessions at any time. Well, ladies and gentlemen, thank you for joining me for another edition of our open forum Q&A session. I hope you all have a fantastic weekend, and I look forward to seeing you next week for our 4 spread presentations in a row, Tuesday, Wednesday, Thursday, and Friday, for all about spread trades. Remember, just go to powerop.com/webinars.asp and then click the Watch Live Webinars link, and you'll be able to register for any of those 4 presentations coming up next week. Again, take care, everyone. Have a great weekend. I'll see you soon. Good night.